And welcome to the VSA Capital Tech and Transitional Energy Podcast on Thursday, the 4th of August. And we're back to normal. The wonderful, the one and only Phil Smith is back with us. Hi, Phil. How was your week's holiday?
It was excellent there. Thank you for that splendid introduction. I was up in Bonnie, Scotland, in the Borders, staying Kelso. It's beautiful. I'm playing a bit of golf. What a gorgeous country.
That was all still green up there, wasn't it? They've had rain. Is that right?
It was pretty dry around the sort of the coast where we were, around Gillane and Muirfield, but there's still a fair amount of greenery about. But it's just really pretty, very nice.
Very good. Well, anyway, last week we had a bit of a diversion. It was just me and talking about my general thoughts, which is always a dangerous subject to get me on, because I can rant and rave. But anyway, let's go. Let's crack on. There's a few things to talk about in tech and transition energy, and actually a few things in brands as well. So I don't know if there's any particular area that you want to start in. I might, as you've been away, let you have first go.
Alrighty. Well, I've just been doing a bit of catching up on the news flow, and I remember we were talking about second quarter results coming in from the US as a kind of guide to what is going on. So just in summary on those, because the markets have had a bit of a bounce back. I don't know, there's a report out I saw on Icon, and it was saying that on second quarter earnings growth is expected at 7.7% year on year. So, and that was more than the 5.6% that was expected. So this is going through all of the results that have been coming out. So I thought that was pretty interesting to see. And on the positive was industrials did well, materials did well, real estate still doing well. This is in the States. And on the losing, financials, communication services, and consumer discretionary. So there we go.
Well, of course, before we get into details of specific companies, I mean, what we have seen in July is actually quite a big bounce back in general in markets. And of course, in the US, we've seen some massive movements in the transitional energy space. And when I say massive, I'm talking sort of 25-50% moves upwards because of the whole bills going through the US to pump money into the space, and Minchin switching his view to actually agreeing. And I think that's something we haven't really felt here over in the UK. But I know, as an example, that I think a lot of people know, I follow the Schroders Global Transitional Energy Fund. In fact, I don't just follow it, I own it, but I also know the fund manager quite well. And in one day alone last week, he was up 6%, but underperforming the peer group slightly, because as he said to me, some stocks were up 25-50%, and I can't have them all. Otherwise, my portfolio on the down days would be horrendous. So it's actually been quite a couple of weeks, shall we say, for the transitional energy space, but mainly in the US, and that's where it's all happening. The US is pumping money to get this all going, and on that point, and we're now well and truly into transitional energy, which is, we all love. But you may have seen a couple of days ago, Cummins announced that they had taken a big investment, 24 million, into Volt Storage, which makes, yes, you wait for it, folks, vanadium flow batteries. They actually make small ones for sort of commercial, household use. But Cummins is coming in to transform them so that they can do it more for industrial use. Now, to me, this is really significant, actually, because what it shows is that at last, and we've talked about it for a long time, and everyone said, we don't believe you, Andrew, don't believe you, nothing's happening. The big boys are looking at this space, and they're saying, look, we've got to have alternatives to lithium ion for long duration energy storage. Clearly, pumped hydro is the big one at the moment. You can't have that everywhere because you haven't got mountains everywhere. Although you can do pumped hydro without a mountain, it's just not as effective. But I think this is pretty exciting news, actually. And what's happening in the US should be making people wake up a lot.
Yeah, absolutely with you there. I mean, Cummins are a huge global producer in terms of power generation equipment, things like gen sets. So it's amazing to see them kind of investing in this space, and shows that, as you say, the bigger corporations now are really looking at technologies that are available in the space.
And I mean, it's interesting. I do think that the excitement is going to be in the US. But I also noticed this week, and actually I'd be interested in your views. I suspect you've looked at it a bit more deeply than me. But I see that Sinopec Capital and Johnson Matthey are talking about a strategic collaboration across decarbonisation and hydrogen technologies. Now that perhaps comes across a bit strange, getting into bed with the Chinese at the moment, particularly when, you know, with all the tension that is going on at the moment in the with Taiwan. But it does show that there are still deals to be done out there. I don't know if you've got a view on that, Phil.
Well, look, I do. I mean, I think that it throughout all of the turmoil that's going on at the moment, and a theme that will come out with a lot of our discussions, I think, is that things are still very much going on. Companies are very much looking to the future, and investment is continuing in what are seen as a very strong future growth areas. And China is investing very, very heavily in renewables and combating climate change, doing what it can. And hydrogen is one of those areas. And Johnson Matthey, of course, as a well-established chemicals business, is very established in terms of some of its hydrogen technology, particularly in the catalysts that it provides. So it was positive to see. But as I say, activity is still going on. It's not on hold because of some of the bad news flow we're seeing.
Actually, talking of which, and this does count in transition energy, really, we announced today that we've just raised, it may sound small, but it's very early stage, £1.2 million for Alchemy Capital, which is building the Tees Valley lithium hydroxide plant, which is, in my view, vital for the UK to create this end-to-end battery capability. So, we know that, at one end you've got the mining for lithium, and hopefully at some stage we will get that happening in Cornwall out of the English China clay pits, which are owned by Imerys, the French conglomerate. We know we've got things like British Volt, who are trying to build a gigafactory, but having that processing capability in the middle. And you used a key word with Johnson Matthey, chemicals. You use a lot of chemicals in these things, and these facilities need to be on a chemical plant. And that's what Tees Valley is. It's a chemical plant. It's a free port, and it's also linked into the wind turbines offshore, so that you can actually use green energy to make your green products. Anyway, we closed a deal, 1.2 million for the company today. We actually did it, believe it or not, at a premium, which is not easy in a tough market. And I'm pleased to say that the stock is actually up 22% today, and actually has gone well above the premium that we raised it at. So that was a nice bit of news.
Well done to the VSA team on that one, and quite a result. And I was at the NEC recently for a battery tech exhibition, and there was a lot of talk about the activity that's going on up in, with British Volt, with batteries, and people had come across Tees Valley Lithium as well in the space. So that's all good news.
Very good. Right. Go on, another go from you, Phil.
Well, we can move on swiftly onto the tech sector, because this really has been driving the markets and will be some of these bigger players in a lot of people's portfolios. The Nasdaq is up 16% since mid-June. Apple is up very strongly, up by 23%, and Amazon nearly 30%. So getting back to a bit of what you're saying about the markets and some recovery, and kind of why is this happening is, I think what's quite interesting at the moment, Andrew, is we're not seeing a lot of end demand falling as yet, and corporate demand falling. And like Amazon, for instance, is very, very strong in its cloud services. Probably more challenges in its kind of more consumer products businesses. We know with costs and delivery costs and employee costs rising, but cloud services is very strong for Amazon. And Apple doing very, very well too in smartphones and demand for smartphones. So things not being seen to slow quite yet, or maybe as dramatically as expected necessarily, given, as I say, given the news flow that's around. But
let's just pick up on your point slightly, Phil. I mean, I think you have to differentiate slightly between areas. So, for instance, we know that things like Netflix, for instance, we are seeing subscribers come off. And we have had a few companies that we may come on to in a second in the brand space, which have had profits warnings. So I think you have to look at it and say what sort of consumer is really getting squeezed the hardest, and also what will that consumer cut out. Now, what he might clearly, if you've got, Amazon Prime, Apple TV, Disney TV, Netflix, you might say, actually, I need to cut back on them because I can actually watch the BBC and ITV for free, effectively. I've got to pay for my license, of course. Whereas you're not going to give up your iPhone. People just live on them. So you need, and again, certain things are, shall we say, used by people who have more cash, and therefore the squeeze is not hurting them quite as much. So I think you do have to do a little bit differentiate, but I think you're right. I mean, the one great thing about an awful lot of technology is that it's basically embedded in our lives and we can't do without it.
Yeah, absolutely. No, fair point. I mean, when you're looking at any sectors, looking at the specific spend and spend that's vulnerable. But I just remember going through the kind of Lehman's downturn and stuff, and how quickly actual business spend and capital spend came off. And it's interesting, we've not got to that point yet. And that doesn't seem to be readily on the horizon. But yeah, you're absolutely right. Some of these, the consumer areas that are going to be softer and where you can quickly cut down your expenditure on tech. Yeah.
Well, and again, there's a big difference, Phil, I think, between business and consumer, B and C, because one of the things that I've been talking to a lot of people about this and having a bit of a rant, to be honest with you, is that businesses today are actually in pretty strong shape. And the reason is very simple, and this is a global phenomenon, is that during COVID, i.e. the last 2 years, companies that certainly were listed on stock markets were able to raise literally billions and billions of pounds. The stock markets were incredibly good at shoring up businesses, and they've left them all with very strong balance sheets and in a very good shape. And so, of course, businesses can keep spending money on technology and upgrading their capabilities and making themselves stronger. They can go out and do M&A. They've got the funds. And actually, that's one of the really big things that people forget about stock markets. Oh, did they work well during COVID? I mean, they were incredible. They probably saved the UK economy. Yet what politician ever actually points out that it was the stock markets that saved the UK economy? What politician ever says, actually, how do we help the stock markets function better? And how do we incentivize people to put new money into our companies? Because the best way of putting new money into companies is through the stock market. You have a tradable equity. If you do it through an IPO, through a placing, you are helping that company to grow. You are creating jobs. You are creating wealth for the country. Yet the government never seems to appreciate that. I'll stop now. That was a rant, wasn't it?
Well, I don't think that was right. I think that was a good set of very, very valid points indeed. And as a SIP holder for my pension, it also creates wealth for pensioners or would-be pensioners. So it's it's hugely important for the economy. It creates jobs, and I think you've raised some very fair points that you should get across to those candidates for the Conservative Party leadership. So, I mean, I will point out that the one problem with the stock market, right, is it can be absolutely ruthless. And I think it's what scares people. I mean, I think I've talked about on this before how private equity is, in my view, is just a Ponzi scheme, because they just keep putting the values of their businesses up and up and up and up, when clearly they're not going up, they're actually going down. And there's a disaster that happened in private equity. But I was looking at, and this is the brands bit, but Revolution Beauty, which was floated about a year ago at 160p. I mean, they had a small profits warning the other day, but it was only really small. They're still going to make about 20 million EBITDA. The stock's gone basically from 160 to 20p. That is one hell of a hit. And I guess that's what frightens the hell out of investors, that something like that can happen. But I mean, if you just think about it, right, at 20p, this company now, it's about to make 20 million EBITDA. Right, it's got a market cap of only 60 million. I can tell you, it's on 0.3 times sales. Most brand companies are trading on 3 times sales, 10 times higher. All right, that means it's only on 3 times EBITDA. And actually, that is too cheap. And I suppose that's what frightens a lot of people, is that sort of a hit can happen, and you see all your money sort of fly out the door, which is quite a worry. And so that's the downside of equity markets.
Whilst on brands, by the way, I'm just going to have a little bit of a mention here for one of our clients, Samarkand. And I mention it because obviously it has high exposure to China. And a lot of people have been ringing me up recently saying, Andrew, with what's going on in Taiwan, et cetera, Cold War II, all this sort of stuff, is that going to impact Samarkand? What I would say to people, and I'm just sort of saying it publicly now, is look, Samarkand has actually some very unique technology. I happen to believe that clearly what's going on in China isn't necessarily good news. It's a bit of a black swan event. But at the end of the day, there will still be a lot of people in China with aspirations to be able to buy Western brands. And therefore, it's not all over. It's perhaps a little bit more complicated. It perhaps slows a little bit whilst we're in this Cold War II, but it's still a really good business. It's got people like SF Express, which is the Chinese equivalent of, FedEx or DHL, and it's actually got DHL as a partner, and it's got Smollen as a partner. It's really well set up. So yes, China is causing it a few issues, and the share price has come back because of that. But actually it's still in a very good position. So if you want more information on that, do just perhaps message us directly.
Yep, absolutely, Andrew. That was all well made and very well timed comment on Samarkand there. But you're right about the technology and the platform and the acceptance it's been getting by some major providers in the logistics space, which is always a great validation software.
And a bit like the Hut Group, they do own some of their own brands, and we reported the other day their own brands, or they reported, and we reported on them reporting. If you follow me, they're actually performing really well. So they actually have another arm to their leg, or whatever the word is, leg to their stool, something like that, and that helps them. So anyway, moving on, because I'm getting myself in the right tizwas there. Phil, your go.
Yes. Right. Okay. On to results, because there's been quite a few results coming through. IP Group had their interims. And IP Group has a whole range. It's a very well-known technology investor, early stage tech, advanced growth tech, the big portfolio companies. But as they had their interims, the share price is 87p, the market cap's 900 million. And they reported that their net asset value of their investment portfolio is now valued at £1.4 billion. And that's 137p per share against a share price of 87p. But the interims reported a loss of 310 million. But part of that, as something we discussed, was down to a reduction in the value of one of their investments, Oxford Nanopore, and they have to, the value enough that it's public market valuations. Now, excluding that, the company IP Group made a profit of 35.6 million. And so, they got plenty of cash on their balance sheet. They continue to invest in companies, which we want to be seeing. And it's trading at quite a discount. And the shares have had a bit of a bounce back as well. And I think, in my view, rightly so.
Quite a discount, a huge discount. Look, I think we've talked about stock many times. I think it's a really good way of playing the technology sector. I do own it myself. And, obviously they do have to mark to market to a certain extent and write down their holdings because they're a quoted company. Private equity should be doing exactly the same, but doesn't. But IP Group's a good company. It's too cheap at the moment. It's well run. It's got a great portfolio of companies. To me, it's an outright buy.
Right. Well, we could be clear on that one. And just to add, Nexion, which is one of their investments, is a battery materials developer. In fact, they're developing, I think it's silicon-based anode technologies for batteries, and they just announced this week as well that they've closed the fundraising, which totals an investment of $170 million. So you can see the types of companies that they're dealing with here, and the sorts of investments that they attract.
Yep.
Okay. So swiftly moving on, Megit, that's MGGT's a ticker, 6.2 billion. This is one of our most advanced engineering companies. It's very much an international business, and they're heavily involved in aerospace and defense, but also energy markets. Investors might not have come across Megit, actually. They make advanced composites for aeroframe structures, altimeters, they pronounce, Andrew, flight deck instrumentation, sensors, engine systems. So very, it's advanced engineering tech company, and they reported their interims. And interestingly, and getting back onto consumer behavior, consumer spend, and all of those that are traveling, their civil aerospace related organic revenue was up 30% in the first half of this year. So a very strong bounce back, and they had seen strong growth in their order books as well. So, this whole thing about looking what's happening in society, how people are behaving, and how that's driving spend in specific areas. You can see that filtering through to Meggitt's results, and their order books were up on an organic basis by 38%. So that was a good set of numbers from Meggitt.
Yeah, we had a few figures this morning. They all look pretty good, didn't we? We had Meggitt, we had TT Electronics, we had Spirent. You may want to comment on them.
Yeah. Well, TT, I missed out on that one. I just covered that one, but Spirent.
Well, I can tell you, TT looked pretty good as well, actually. So, but yeah, tell us about Spirent.
Yeah, so Spirent, tickers SPT, 1.7 billion market cap. It's up 13%. Shares are in the last month. Spirent is a global brand in test equipment, and it's the sort of test equipment that is used to test things like mobile phone handsets, used by worldwide manufacturers of handsets, 5G networks, cloud systems in data centers. So if you're developing new kit, you've got to test it. You've got to make sure it meets a certain specification. That's what they do. And they reported first half figures, and they have seen their order books up by 30% to £284 million. Revenue was up 10%, 280 million. It's test equipment, it's high value. Look at the gross margins. They made gross margins 72%, and operating profit of 49 million, up from 45 million. And this company, boy, does it generate cash, and they're sat on 190 million of cash. It's a really high quality business, but you can see, their spend here is driven by 5G networks, which we've talked about a lot, the investment in 5G networks, but also in cloud computing infrastructure.
I'll tell you another. It's been a favourite of yours for a while. Another favourite. I'm sure you looked at it on Tuesday. Filtronic had results, didn't they? And they look pretty good.
Yeah, I did. Yeah. It's a smaller company, 32 million market cap. Tickers FTC. Their shares are up by 21%, I think, over last month, something like that. But they specialise in radio frequency electronics. So this is microwaves, millimeter wave technology. So all the stuff that's used in highly advanced communications. So aerospace, defense, telecommunications infrastructure, satellite infrastructure. So they had a good set, full year results, and they saw their revenue go from 15.6 million to 17.1. But all more importantly, their operating profit jumped up from 0.6 million to 2 million. So good set for smaller grades, very specialized engineering tech kind of thing we love. Nice growth in profits, good market exposure, and they've got 2.2 million in cash in the balance sheet.
Actually, all the stocks we've been mentioning over the last year, they're all performing quite well, aren't they? Now, I'm going to go a little bit off piece and see if you can work out which company I want you to talk about next. I'm going to go tuck, 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 tuck. Come on, Phil, that was such a good clue. It was a great lead in. There was a placing this morning and some results from a company.
Oh, hey, there was. Is this Saeta?
That's the one, Saeta.
Hey, well done. Nice one. Right, anyway, this is a UK-based electric motor company. And they raised 23 million pounds. It IPO'd just over a year ago, I think. And they had their full year results as well. I think the revenues are about 3 million pounds, but raised 23 million of capital, and they announced a new American automotive partner who's going to be working with them on their technology. So,
which is probably why they were able to raise 23 million pounds. But well done. That's a great. I mean, in midsummer when the markets are tight and closed, to raise 23 million pounds, I've got to give credit where credit is due to Canaccord Genuity for that. Well done.
Yeah. No, that's super. And again, look, it's great to see UK tech getting proper backing, being done on the stock market and raising that quantum of money.
Now, I'll tell you, there's one other I think we should actually mention this week. I don't know, Phil, you may not have been watching this, but there has actually, you were talking earlier about stocks over in America performing incredibly well, but have you been watching AMTD Digital on NASDAQ?
No, missed it. Go on.
Yeah, missed it. Well, I'll give you a clue, all right. This stock IPO'd at about $17.80 about 10 days ago. Do you want to have a guess at what the price is today?
Well, the Nasdaq's been going up, so probably $19.
Keep going higher.
Oh God, really? 25?
Oh, Phil, come on, higher, higher, higher.
Yeah, what does it do? Come on, what is it?
It's a good question. I'll give you a clue, all right. Actually, today it closed at only $1,100.
What?
I.e., 100 bagger in a fortnight. All right, but it didn't peak at about $1,600. I.e., 200 bagger in a fortnight. Now that's the sort of stock I really like. And why didn't we tell everyone to buy it, if you see what I mean? What do they do? All right, it offers services to develop online businesses, financial services technology. It's got 50 members of staff. For one stage, it was bigger than Alibaba, and it does about $25 million of revenue. Not bad. It's what we call a mem stock now. These are stocks which in America get picked up, and the retail investors just go bananas, not having a clue what they're doing. I'm thinking that maybe we could turn VSA into a mem stock and watch us go to worth billions of pounds. Talking of Alibaba, though, also just quickly worth mentioning, in case people haven't seen it, but SoftBank have sold about, I think it's 20 billion of their Alibaba shares through a whole complex system of derivatives. And SoftBank are raising a lot of money at the moment. Obviously, they're also selling their ARM holding. But I think there's an interesting point here is that actually, if you look at SoftBank, it basically became incredibly successful on the back of Alibaba. And at one stage, I think Jack Ma was the richest man in China and Masa, the richest man in Japan. And yet, clearly both now are fading in wealth and in notoriety. That's a difficult word to say. Which is interesting to me. It tells you another bit of a story, I think, about what's going on perhaps with China and that sort of thing. Also, I mean, not really necessarily technology, but I don't know if you saw Maersk had a profits warning this morning on weaker container demand, which also tells you a little bit about supply logistics, etc. So worth bearing that in mind.
Yeah, it'd be interesting to see what happens to container prices, because that's just generally had a huge impact across the across all businesses, many businesses. So well, that could be not good for my shareholders perhaps, but maybe good generally. Might see rates come down, so that'd be a good thing.
Anyway, anything else from you, Phil, that you want to bring up?
I don't think the only other one I saw in terms of results, and this is a company that I followed for a long time and had liked and must be a bit of a surprise for a lot of shareholders, was XP Power. XPP had their interims, and they make power supplies that go into semiconductor equipment, healthcare equipment, industrial applications. So very high spec power supplies, and they have had quite a few issues here. Looks like their interims to June order intake was up 18% to 23% as reported, involving currency, 193 million. So that's a big positive tick. Revenue growth constrained by industry-wide component shortages, which we've had for a long time. Lockdown in China, they've got a manufacturing plant in China, expanded component lead time. So yeah, quite a few issues there. So component supply obviously impacts production volumes, and that hit their profits. So that was not good. Net debt is up. There was a legal case, Comet Technologies, and the court found in favour of Comet and awarded damages of $40 million against XP Power. So certainly impacted the share price. That's a real shame to see, and hope they get recovered from some of this.
Yeah, you've thrown the whole book at that one, Phil. That doesn't sound at all good. it has to be said that this stock was trading at a huge price, wasn't it? It was sort of up at £60, was it, or something?
Mm-hmm. Yep.
And now it's down to £21. It's got a harsh fall.
It is, and it's one of those situations to sort of keep an eye on, because at the end of the day, underlying is an outstanding. It's got a fantastic customer base. It does have a good product that does command, in decent markets, commands very, very good margins. So, it's fundamentally what they call a good asset, but just right now going through the mill.
You tell us and all the listeners when to buy it.
That's the thing. Okay, I'll plot my course on that one.
Very good. Right. On that note, we've been chatting for about 30 minutes, so we don't want to bore everybody to death. We'll call it a day there. Please, as usual, it's great to have you back, Phil. Any comments, send them in. Any requests, send them in. And we will chat next week.
I look forward to that, Andrew.